America is strapped. We're looking at people that can't afford their houses. We're looking at elderly that have to sell their home because they can't afford their taxes and their insurance. There's a lot wrong with this market.
The market right now is on a high wire. Prices are so high now.
Do you think the Fed has, what tools do they have that will save the housing market?
What can they do? I don't know how they get around it unless there's a correction of some kind.
The market has been manipulated to the point that I don't see any fixes. I think a correction is the only way. There is no fix other than realizing there's been big mistakes that have been made. We have to learn by our mistakes. The only thing that makes sense is that we get ourselves back into an economy where people can afford stuff again. Look, I just try and be as transparent as I can. There's no secret to what I believe is coming, and we're seeing it. People want to say, you've been talking about this for years, and all right. Well, when you start seeing inventory going up 40, 50%, 100% year over year, you start seeing price drops, you start seeing the days on the market, you start seeing sellers panicking, and you're talking to them, and you're like, yeah, I'm sorry, but you're going to have to drop your price. You're not going to get what you could a year and a half ago. These are facts.
Hey, Todd, it reminds me of 2008.
John Wake, welcome to Sachs Realty's podcast.
Thank you, Todd. This is a blast to be here.
Yeah, I mean, I'm surprised when I saw you on X. That's where I originally saw one of your posts. I said, man, I don't know this guy. I'm kind of surprised. I report on the housing market, and so do you. And so I'm glad that you answered my message, and I did a little background, watch some of your prior videos. Looks like you have a YouTube channel. We'll drop all of the links for everyone in the show notes below of really everything that we're covering today, the articles that we're going to pull up. But it was, I thought it was, I was kind of curious, and I want to learn about you and introduce you to our audience here, but I'm kind of curious as to why you haven't really, I haven't seen any recent videos. I haven't seen anything in the last year or so. So hopefully we'll find out why. But John, why don't you just take a minute, let everybody know who you are. I know you write a Substack. I've been on that as well. And just introduce yourself and tell us about you.
Okay, well, I'm a real estate numbers nerd. So I got a degree in agricultural economics, and I worked at USDA as an economist for a few years, and then worked at the American Embassy in Paris as an agricultural attaché. Came back to my home in Arizona, and then eventually I got into real estate in a weird way where it's like the year 2000, and being a data guy, I found out that the sales prices was public information in Arizona, but no one knew. To find out what a home sold for, you had to talk to a real estate agent. So anyway, I ended up setting it up. I would buy the raw data and send out an email newsletter. I had to put a server on I had to create my own email server, not create it, but set it up and send it out every week. So you subscribe to your zip code and show you the official sales price of the homes in your zip code. And I thought I was going to put on advertising for that, and that didn't work so good. But I got all these leads. So after like 2 or 3 years, this is like 5 years before Zillow, I'm going, hey, you moron, you have all these leads. You're not making any money. Why don't you start selling real estate? So I started selling real estate. And once I started selling real estate, I got so busy because this was like, I guess it took off. I got the license 2003. Of course, 2004 was busy. It was busy for crazy for a while there. So the website just didn't get up. I would update the data, but I didn't improve it for years and years. And by the time the market crashed, so many years later, it was passé because there was Zillow and Realtor.com and everything else had come in. But so then I've tried a lot of different things, but I'm pretty much mostly retired now, but I'm still a data guy. My thing is trying to figure out, ever since then, is like, how does the economics of real estate work? It's kind of a mystery because a lot of the information you get is just being from people who are they're talking their book, right? They're just trying to get you need to buy now. It's a great time to buy. Prices are going up, great time to buy. Prices are going down, great time to buy. So it's hard to figure out how the market really works. So that's my big thing, is trying to figure out real estate market.
You're not licensed now?
I am licensed, yeah.
Oh, okay, so you still have it.
I'm still licensed, but I just sell to friends and family. I'm pretty much.
Yeah. Yeah, well, it's interesting because I've been in the housing market forever, for a long time, but as a contractor and a builder, and I date back 35 years. I don't. It's kind of scary to even say. I started back in 1989, but I didn't become a licensee until 2005, so right before the GFC, and of course, but I was involved in the whole process. I mean, I watched what happened, went through a couple booms and busts, and in the Maryland, Virginia, DC housing market, and as a contractor through the years. But before we dive too deep, because I do want to talk, it's interesting. You could have been the Zillow. You probably could have been ultra zillionaire right now. But they made some bad mistakes, which we're going to talk about in this show.
Maybe if I had
But
your management skills, I could have done that.
I don't know about that, man. I tell you, I wasn't the one collecting that kind of data and producing a website 25 years ago. But it's amazing how the technology, people don't really think, our kids don't think about, or grandkids don't think about, like, what was it like when you didn't have the internet or Zillow and things like that? I'm just kind of curious as we dive in here. Are you able, John, to talk on more of a national level with what you see and feel with the housing market, or are we talking mostly with your data and thoughts, the Arizona or Phoenix market?
I kind of split it into two. I have a website, realestatedecoded.com, and that's national stuff. And then I have the local one, Arizona Real Estate Notebook, which is the local stuff. So I kind of split it that way. And each one is tied to a Substack. But if you want to look at my post from 2009 or something, you got to go to the website.
Yeah, well, that's good. So we'll talk on a national level, but we'll also talk a little bit about the greater Phoenix area and your area as well, because I think a lot of what we're going to address today or unpack is, the catalyst behind the exuberance, the hysteria, the disaster, I'll call it, that we're currently in with a housing crisis nationwide. The affordability crisis it's so apparent, and why some people thought that this would just continue to go and rise and not fall is beyond me. They obviously, don't understand economics. But what is your? I know a couple years ago, I watched a couple of your videos. You were talking about, and I've been talking about it since 22, and it has fallen. And real estate is sort of like a slow moving market. It's not like all of a sudden, boom, tomorrow house prices are $100,000 less than they were today. But you were saying along the lines, same lines as myself, and saying that this doesn't make sense. You were expecting home prices to fall. And again, they have in a lot of ways. I have a chart that I want to pull up here in a minute about the Phoenix market that you posted, if it's okay with you to use. Okay, good. But tell us, what do you think now?
I think, well, the market right now is on a high wire. It's been stable more or less up and down for like almost 3 years. So but it's on a high wire. If we get into a recession or anything bad happens, it could really tank. So that's the downside risk. But what I'm thinking about what's going on now is different than in the past, than 20 some years ago, is that the government is so much more involved. Like, you had a great interview recently with the guy about the taxes and that issue where everybody gets forbearance. You don't even have, some people don't even ask for it. Oh, they missed 2 payments. Okay, we'll just tack it onto that did not happen in the 2005 boom. And then also the government is more involved, which I think, like, forbearance, eviction moratoriums, things like that didn't happen in the past. So that reduces the downside risk, but is that good or bad? Because you have countries like Canada and Australia where they didn't have a correction in 2010 or in that time period. And holy mackerel, home prices are crazy high there today. So we may be headed towards that kind of a situation if the government says, okay, we don't allow prices to correct. So if they go down, well, of course, prices in Scottsdale, in Metro Phoenix, the median home price fell 60%.
Let's pull it up
60%.
while you're talking
Oh,
about it.
oh my God, that was incredible.
Yeah,
So we
let's
wouldn't,
take a look at it, John. This is your chart, right?
yeah, that's from somebody I subscribe to. And that just shows you that the government, I don't think, would ever allow that because they're so active now. I don't know if that's good or bad, but nevertheless, they're so active now. I don't think they will allow it. Now, would they
But
allow
this
it to
is
go down 10 or 20%, just a normal sort of correction? That's something that I think is a lot more likely.
10, 20%. I mean, a lot of people say, well, that's nothing, but I mean, it all adds up. It all helps. But a lot of people that I talk with, including even my own thoughts, I think some markets may go back to pre-2020 levels just basically on watching this thing fall. I mean, here, one of the things in noticing this chart, and do you remember who this is? This is from Cromford.
The Cromford report. Yeah,
Gotcha,
I subscribe to them.
Okay, great. So we'll give them a shout out here since we're using their chart here. But when you look at if you go back into my videos, you'll see that I talk about the real estate market peaked in 2022, and this is a good example of that. Where in 2022, and now we've seen prices fall, and I'm always getting people that are saying that it's not true, that they're listening to the year-over-year data, but a lot of this is skewed based on who's buying the house, how many houses are being sold, and what price range. So, the problem is that people don't really look at the actual real data because a home is not fungible. It's not very easy to compare two houses side by side. And it doesn't always mean that you can sell. And I think, but we're going to dive in a little bit here. But it's easy to see in a lot of markets, home prices have been falling really since the peak of 2022. But I guess, we're looking at everything's expensive. I mean, it's, since the Fed started raising rates in 2022, they raised them 11 times in a row before they stopped, right? So started in March of 22, 10 more consecutive rate hikes, the fastest, the hardest and fastest in the shortest period of time that any Fed has ever done it. And I mean, do you think they should have raised rates before?
Oh, yeah, absolutely. And I don't think the other thing that was so stupid that they did the liquidity thing where they were buying mortgages. What the heck? It was the Fed chair from the 90s. He was really into the wealth effect. Like if you lower rates, it makes people's home prices values go up. So they spend more money, which is good for us, the Fed, to boost the economy. So they were very much into that. They never did that until
You're talking about Greenspan?
Greenspan, yeah. And then when they started doing that, that just made mortgage rates go even lower than they would otherwise. And so I kind of think that the Fed is basically using what? Main Street to boost Wall Street. And so it destabilizes Main Street to boost Wall Street because, well, it was great when prices are going up, but then when they come down, oh my gosh, everybody's trapped and it increases the downside risk. So I do think the Fed is manipulating housing to stabilize the market. Because when rates go down, what happens is people maybe invest a little bit more in their factory, or I think a bigger effect is their wealth goes up in their house, and so they spend more and they take on more debt.
The problem is, though, which we know and we're about to see, is that it can't go any higher because no one can buy it. And, there's three levels of buyers, really, right? There's the rehabber that buys completely distressed property. Then there's the investor that wants to a lot of times buy turnkey or multifamily, and they're wanting it for cash flow. And then there's the retail buyer that's at the top. Well, the retail, everybody's tapped out. The rehabbers can't make any money rehabbing, flipping houses. The investors can't make any money because the rents, don't make sense to what they're paying. And now the retail buyer's completely maxed out. And on top of that, the Fed's really made a disaster. On top of that, I mean, they can't afford their credit card payments. They can't afford their car payments. They can't afford their mortgage with taxes and insurance. So do you think the Fed has gotten to a point to where, I mean, what tools do they have that will save the housing market?
What can they do? Prices are so high now. Let's say they lower the rates a full percentage point or something like that. That's nice. But the prices now are based on 3% or less mortgage rates. And houses are famous for being sticky on the downside. But the reason they went up was those low mortgage rates. And now these prices are set or determined by those low mortgage rates. So they're not going to be able to get back to 3% mortgages. And I don't know how they get around it unless there's a correction of some kind. It could be, I guess the ideal scenario would be, prices stay flat for 5 or 10 years. And so the real price, but that's pretty bad for people who have a young family or something, need to buy now. It doesn't help them if prices are good 10 years from now, or maybe 5, but holy mackerel. But also, they just came out with the interest rate. The inflation was up 3% over the last. It went up a little bit in the latest number, so that lowers the odds they're going to lower rates. The interest.
Yeah, I don't think Powell is. I know Trump said. Well, he came out and said that that Powell made the right decision after he said that the interest rates needed to come down. I think the big thing is that mortgage rates have already baked in what has come down as far as the Fed rate, and they're not changing. I mean, and what role do you think? Now you're in the Phoenix area, Scottsdale, Arizona as a whole, but Phoenix, Scottsdale. I mean, your area is pretty hot. I'm sure still, or is it? Is it not hot, Phoenix or Scottsdale?
No, it's normal, so to speak. The amount of inventory for sale, what I call the supply for sale, is 40% more than this time of year a year ago, and it's kind of very similar to actually 2016. 2016 was a normal kind of a year, so it's normal right now. But we're at a point, if it keeps going up, we could get into a point where it's putting downward pressure on prices. But right now, it's normal-ish, but way higher. The supply for sale, the inventory, is way higher than it has been for years.
You had mentioned the Fed. One of the mistakes that will eventually everybody will realize was buying mortgage-backed securities and suppressing mortgage rates to that 4% or lower.
Manipulating the housing market for their purposes.
They didn't start doing that until after the 2008 crisis, I think somewhere around 2011, 2012. And because they needed to encourage people to get back into buying again. I mean, who in the world wants to finance a mortgage other than the government? And who wants to give the rates away other than the government? How much of a role do you feel in this housing crisis were Wall Street type investors, funds, institutional buyers?
There was some, I think most of it is not. Is the small investors, the mom and pop investors are most of it. But particularly the during the bust, like 2011, something like that, one of the big institutional buyers got started in Phoenix because prices were insane. Like I said, prices fell 60% for Metro Phoenix. So they were coming in here.
Are you talking about Opendoor?
No, I was thinking of another one. Maybe it was Invitation Homes, and they later moved to Texas. But that was Opendoor as well. That was later on. That was like 2015. But I don't think they were huge. But that was part of the investor market. But it was not half. It's 20% or something of the investor market. But there were some markets, like I think Atlanta, that was super high percentage. I think Atlanta was the market that had the highest investor.
Parts of Texas were over 50%.
Oh, wow.
Yeah. 52, 54% of the home buyers during the 21, 22, 20 into primarily 2021. A lot of the markets were over 50% in certain markets in Texas were investors.
Investors or institutional investors?
Investors. I don't know what the breakdown was in institutional, but non-owner occupied buyers. People that are buying it to rent, not for speculation or to rent, not live in it themselves and get established in a neighborhood.
One of the things people talk about, Todd, is like, oh, the prices went up so much in 2021, 2022 because the supply was so low, the inventory of homes for sale. So I looked at it. In 2021 compared to 2019, pre-pandemic, the amount of purchases by live-in owners, owner occupants in Phoenix was lower, actually was lower than in 2019. But institutional or investors was more than double. That's what was driving down the inventory and raising the prices was, well, first the Fed lowers the interest rate. And so let's say you were thinking of buying in a year or two. Okay, interest rates are lower. I'll buy now instead of next year or whatever. So you get some of that. But then if you're an investor, you think, oh, I'll buy now, or instead of buying one, I'm going to buy four. And so that the investors, when the interest rates are down, they were a lot more sensitive to the lower rates and just came in. And like I said, they doubled where people living homeowners actually bought fewer homes in 2021 than in 2019. So that's what caused it. Is this, you got to realize that investors are a lot more sensitive to lower interest rates than Joe homeowner.
Yeah, they get money way lower too when they're having everyone else invest in their companies and buy their stocks and shares. It really isn't their money. I mean, it's, hey, look, I like to gamble with other people's money too. Why not? I mean, it sounds like a great idea, right? I mean, the unfortunate thing is that they hurt a lot of people that invested in them.
Oh, yeah. Also, when interest rates were going down, that meant that their other investments weren't as good because interest rates are down. So then they go into, let's say you're an investor, you can borrow what? If you're in stocks, you put $1 down, you can borrow $1 to buy more stocks. But in real estate, you put $1 down, you borrow 3 more. So holy mackerel, that means they brought a ton of money into real estate.
I hope you're enjoying the interview so far. I just wanted to take a brief moment and let you know that this podcast is brought to you by SachsRealty.com. Here at Sachs Realty, we're committed to bringing you the best real estate education and helping buyers and sellers achieve their real estate goals. If you haven't subscribed to our channel, please consider doing so now. And don't forget, we're on every major social media platform, so you can follow us there as well. Now back to the show. I think the National Association of Realtors statistics, and which are probably low, it's interesting. We talk about inventory, supply and demand, and all this stuff. But I think what we have really forgotten to realize is that a lot of transactions over the last boom cycle happened off the MLS. I mean, I can't tell you how many transactions where I had somebody, I would go to their house to list their home. And I would talk to them and they'd be like, well, we've got these 4 buyers that we want to protect ourselves against because, our neighbor's kid wants our house, or, the neighbor's, sister down the street wants our house. So people were buying them without that. And then without an agent in a lot of cases, and without ever hitting the MLS. So that took a lot of MLS inventory out of the market. But then we've underestimated all of the wholesalers that are out there hustling properties. We've underestimated all the, sub to or subject to investors that are out there, sending postcards, sending letters to people. I'll buy your house. I'll pay you $1 gazillion or whatever. So a lot of people called those investors directly, and that took a lot of the inventory. At the same time, we didn't have the builders reporting all their inventory either, and they still aren't. So the builder doesn't have to tell you that they have 150 available lots on the MLS. They don't have to throw that in land or put spec pictures on them and flood the MLS with these. And so they're really, so we get a narrative where we're telling people that things are really not what they really are, and that contributes to the overspending or the continuation to a period of time. I want to talk about I want to get your opinion on what did you think and what do you think now as an agent? Now, you entered into the business around as a salesperson about the same time as myself. When we started in the business, Zestimate, Zillow, was just a new thing. I mean,
Yes.
It didn't exist. In fact, I think when they first came out, I remember when we were advertising as agents, There was the real estate book. And then when they digitized somewhere probably around 2005, 2006, you could do their digital marketing arm, because Zillow wasn't just automatically aggregating and taking our data and our clients' data and selling it to people, other agents. They weren't doing that. They weren't making billions of dollars. You had to pay as an agent to put your home or your listing. It was like you had to pay more money to get it online, right? Let's talk about Zillow and their Zestimate. In the recent years, the boom, the pandemic boom, we'll call it 2020 to 2023, even call it into 2024, not so much. But what role do you think, or responsibility does a company like Zillow have in where the home prices went to?
Well, part of it is Zillow, and part of it, I think, was just the technology. Because like I said, in 2000 and early 2000s, you wanted to know what a home sold for down the street. It was just hearsay. Neighbors would say. So as time went on, in fact, in the 2005 boom and bust, I was thinking, this wouldn't happen if we had more data, because the people are paying too much because they don't know what's going on. And then it turns out that in 2000 and whatever, the pandemic boom, that data allowed people to go crazy and made things more unstable, because they could see, oh, that house went for that much. So we got to come in before it goes up even more. And so you get this crazy, they expect houses to go up higher. Something that Zillow did, Zillow used to base all of their estimates on past sales. And I remember real estate agents just hated Zillow, because they would have somebody's like, I had this, but then my buyer saw the Zest guy. They really did not like Zillow. They didn't want to advertise with them, whatever. So what they did about 2019, they changed the way they did their Zestimate. So once an agent put in a list price, they started including that in their Zestimate. So you would see that the realtors were happy now. Oh, the Zestimate just went up once I put it on the MLS.
They matched the price.
Yes.
They matched the price overnight.
And so then the realtors quit complaining ever since then about the Zestimate, but it helped make buyers feel more confident in paying that. And in a way, it's the Zestimate. They're taking advantage. They're not paying this realtor who did all this research to get the value and the updates. They're taking advantage of that, their knowledge, without paying them. But nevertheless, if you look at Zestimates, they did a good thing. They started showing their error range, and you would find out this is a Zestimate. The error was huge. Before, they didn't do that. Now, if you look deep down, you can find out, it's not that accurate. Another way to get a better estimate is you look on Realtor.com and read a few of those kind of estimates. You find out how variable they are.
Well, I hope that you would agree with me. First of all, I thank you for your transparency, because a lot of agents, they wouldn't admit to that. And I can remember one time in 2021, you would go to somebody's house for a listing appointment, and they'd say, yeah, what do you think my house is worth? Well, Zillow says it's worth, $450. I'd like to advertise it for $600. Because things are selling quick, and I think that's low. And before, they would say, well, you'd go in and you say, well, your house is worth $400. They'd be like, I saw on Zillow it's worth $450, and you're like, well, they're not looking inside your house, okay? They're not seeing the ripped up carpet and the this and that and the deferred maintenance. So then it flipped on us, right? During the pandemic boom, it was, well, I saw my house is worth $450 on Zillow, but I think that's kind of low, because, I think my house is worth more money than, I want to put it on for $600. And you're like, all right, well, I don't think you'll get it, but hey, we'll do. And then all of a sudden they got $650, and you're like, but here's what I would do. I would put that house in the market. I remember specifically, I think I put the house in the market for $640, and Zillow had it at $450. The day after I listed the property, Zillow put it to my price.
Yes.
So, but by this time, I mean, come on, we're talking about Zillow from like 2006, 2007, maybe, until now became one of the trusted resources for home prices by home buyers and sellers. Look, forget you and me. We're nobody compared to what they see online. And the bottom line is buyers and sellers don't go to us initially. They search on Zillow or Trulia, which they own, or Realtor.com or wherever. So the question is, how much responsibility does a company like that reported inaccurate data to the point that it cost them $1 billion, their shareholders $1 billion, with their own company, their own iBuyer called Zillow Offers? I want to show you something, but before you answer that, let's look at something for a second. And again, guys, I'm putting all the data and all John's information, which I'm really enjoying this conversation. I hope you are as much as myself. But I want to just look here, pull up this Zillow group. This is 2021. Now, this is, by the way, this is public information. They're a publicly traded company. They got to publish this data, but you got to dig for it a little bit. Look at this. Here's their report. Now, all of a sudden, right before you get to all the numbers, which good luck with that, unless you're a data analyst or a accountant. Traffic to Zillow Group's mobile apps and websites in Q4 was 198 million average monthly unique users. Flat year over year. That means it was the same in 2020. Visits during Q4 were 2.2 billion. That was down 5% year over year, with average monthly unique users for 2022. There were 220 million average monthly users. Visits during 2022 were 10.5 billion. So, you think people were relying on what Zillow had to say?
Totally. But when they did have, remember when if they had a low Zestimate, they would discard Zillow and say, that's too low. They're not any good. But if it was high, they loved it. They would say, oh, that's the best estimate.
They were matching the list prices in my listings.
Yeah. And that gave buyers a lot more confidence to overpay. Because, okay, well, we'll just pay a little bit more. The market's so hot. I've already lost 3 offers. Let's go high on this one.
But they trusted it themselves.
Oh my gosh, yes. And in fact, I think their headquarters, or one of their regional headquarters, was in Scottsdale. And I guess they believed their own sales pitch or something.
Well, here's the thing. I went to the Zillow headquarters in New York. Their main is in Washington State. But I went, Joe, who's sitting here with me right now today, our producer here, we went to New York. We went to the Zillow headquarters. They invited me to this, I don't even know what it was, party, really. I mean, we got to go in. It was only like 12 people sitting in this conference room table. I'm like, why the hell am I here? I mean, I don't do anything. I'm sitting next to a broker who has 1,500 agents, 3,000 agents. And so they flew somebody in from Washington to show us what they knew and what they had. And I was actually blown away. I mean, we're recording. You can find the video on our YouTube channel. It's very fascinating to watch. When we went there, we had to get permission. So they went through the legal department. I don't even know why. Can you imagine them giving me permission to come in with video cameras? And if anybody watches my show, I'm pretty transparent. I'll put the link to that too in the show notes if you guys want entertainment. But it was back in the day when, I just started my brokerage. We were getting on their Zillow's program, providing leads for our agents. But I was like, we go in with our cameras and microphones blazing, and they're like, whoa, we may have made a mistake here. We don't know that we want you. We don't know that we want you in here with this. And they said, well, look, you got to turn off the audio, no audio. But anyway, we sat in this room, John, And I mean, Joe was not allowed in. There was no recording devices allowed in this conference room. And when they peeled back the onion they knew everything about America's home buyer inside and out. It was before all these cookie things, and I don't know that that's changed much. It's a pain in the neck to select your cookie preferences, but this was when they tracked you down to the end of time. And, they knew everything about you. They knew who you were, how many clicks it took, how many houses you looked at before you made a decision. Boom, who you contacted. They believed it themselves. I want to pull up this Zillow shareholders. This is on National Mortgage Professional. This dates back July 21st of 2022, because this sets the stage of what we're talking about here. Zillow shareholders file suit. It says that shareholders' derivative lawsuit claims the company lost more than $1.2 billion on its iBuying program. It says in October 2021, Zillow announced a moratorium on new contracts in the Zillow Offers division, and by November announced that Zillow Offers lost close to $400 million. By the second quarter of 2021, Zillow Offers made up roughly 60% of the company's annual revenues, according to the complaint. And in February 2022, the company reported additional losses amounting to more than $800 million. That takes it $1.2 billion at least that they lost for their shareholders in their iBuyer program. And my question to you as a data analyst, if real estate prices only go up, why would they have sold those houses at a loss? Why wouldn't they have just kept it? Kept 30,000 houses instead of liquidating them. By the way, over 5,000 of them went to Wall Street type buyers, but they were selling them at a loss. So if this company has this kind of data and understands America's consumer this well, and they are invested, they already have the money from their shareholders, why would the CEO, if he didn't think home prices were going to tank because of this skyrocketing valuation to the point of unaffordability, why wouldn't they have continued to raise money, filled them with tenants, and not lost $1 billion because home prices only go up, right? Why would they do that?
That was a big reason. Opendoor and the iBuyers in general were a big reason for prices going up so much, but also on that dip in 2022. And they decided in the end of 2021, they quit buying as much, but they kept selling. So, and then they started selling a lot more. So that was a major factor for the fall in prices in the second part of 2022 was
they're falling prices. They're falling prices.
Yeah, because they're dumping their stock and they're not buying anymore.
They were dumping, but why wouldn't they have held on to them? I mean, it's speculation, but I mean, if home prices are only going to continue to rise, why wouldn't you hold on another 12 months?
I can't figure that out either. Why didn't they turn them into rentals or something? But and hold on. That was I was thinking like in the early 1990s when there was that bust, so to speak, it was mild. A lot of the savings and loans, they would own it, they would foreclose, and they would turn it into a rental for a few years because they were so big. They didn't want to drive down prices anymore. So they would do rentals for a little while. I don't know. It was just some weird decision-making setup or organization. How could they have, if they had so much data, why were they so wrong?
Maybe when they realized that they were wrong, they realized it's about to hit the fan, and they wanted to make sure that they got out before they lost $5 billion. I mean, the thing is, look, I can't speculate for them, and neither can you, but we can come to our own ideas and conclusions. This is not a dumb company. You're talking about Wall Street analysts that are some of the best on the planet, that, you're talking about a company that had more data on America's home buyers than ever anyone in existence. We're not talking about somebody that got into it like Opendoor And I do want to pull up some things on them, but we're not talking about that. We're talking about Zillow, for crying out loud, right? I mean, this is the thrust of the housing. This is like the backbone of America's housing market at one point, right? And they're still around. But my point is why would they have not held on for another 12 months or 24 months before losing $1 billion? I think it's because they have enough data to realize people can't afford houses and the numbers don't work. At some point, light bulbs went off and said, look, interest rates are not going to stay low forever. They can't. The banks now, I mean, who's financing these? The quantitative tightening that the Fed did, saying we're not buying any more mortgage-backed securities. Somebody said, oh, crap. If they're not going to buy them and we're not going to be dealing with 3% or 2.75% 30-year fixed rate mortgages, because that is stupid. If we're not doing that, these prices are not sustainable.
It could have been the thing, behavioral economics, where you get into booms where people see prices going up, they think they're going to go up forever after they've been going up long enough. It sounds like even though they had all that data, their emotions got untied. Hey, we made so much money on those homes that we've bought in the past. Let's do more and more and more. This is great. This is awesome. Let's buy more.
But it happened so
price.
quick. It's not a 10-year period cycle. This was in a short 1 year, 1.5 year period. I mean, this is like a company that made a decision, a flash in a pan, and said, "Whoa, this is crazy."
But there was so much money going into tech companies at the time. They have been thinking, "Oh, we gotta be the leader. We need to get rid of all the other iBuyers and be the iBuyer. So we'll lose a little money now to put out the competition." Maybe that was part of the thinking as well, to take over. Because remember, there was so much hysteria about internet companies back then.
Opendoor. What do you know about them?
I know some of the people that work over there. They're good people. I'm surprised they made such bad decisions.
Let's take a look at I want to pull this up. Opendoor. So guys, these investor firms, these home buying firms, if you're not familiar with them, and I'd be surprised, and there are a lot of people that are just getting into the housing market looking for houses, and they didn't see what it was like back in the day, but there are a lot of people that were scarred from it and figuring that they'll never buy a house because they lost 9 different offers and were outbid, and they've completely been depressed over the fact that they're not making enough money, which is most of America. And the problem that I see that is the biggest problem that the Fed has created here is that the only way around this now is to go back to 2% mortgages, somehow start buying mortgage-backed securities again, and hoping that asset prices don't go through the roof. But the problem is the only reliance that the Fed has on the saving of this housing market, or really any of the markets, is that people will all of a sudden make 50% or 100% more at their jobs. And the problem is this viciousness that's in this cycle, especially with interest rates being higher for longer, is businesses can't afford to make their own bills and carry their own inventory and their own debt, and let alone pay employees even more. Remember, they just got employees, and I know you might disagree with me, but you just got a big jump in salary during the pandemic because a lot of the businesses were so busy and they were understaffed, and they were giving sign-on bonuses. They were giving all this raises to keep people, incentive to keep them employed. And now when the market tightens up, we're seeing layoffs that are happening in every industry, a lot of the industries across the country. But look at this Opendoor stock. Can you imagine? This is what I'm talking about here, guys. We're at the max. We got Opendoor here, June 19th, 2020. By 2021, all right, the share prices were $34.59. I don't even have my glasses on. I can see that. Look at where it is today. I mean, it's at $1.38. Can you imagine if you were one of those lucky ones to say, oh my gosh, Opendoor's on fire. They're buying tens of thousands of homes. They're making money. I better jump in at $34.59. And now today you held on to that stock and your shares are worth $1.34.
It looks like a meme stock just looking at that. Maybe iBuyers were a meme stock, a meme thing.
Yeah.
And so they had so much money and they were so hot they could overpay, help drive up prices.
Let's talk about subprime, because you've obviously checked out our channel and probably seen a couple of the videos, at least before you came on here with me today.
Oh, you bet. You got some great videos.
You know that I am very bearish on the housing market. And it's very, look, I just try and be as transparent as I can. It's not very great for business, all right? I have buyers that are still buying houses, but it is what it is. They can either afford it or they can't. But there's no secret to what I believe is coming, and we're seeing it. We're seeing it. People want to say, you've been talking about this for years, and all right.
Yeah.
Well, when you start seeing inventory going up 40, 50%, 100% year over year, you start seeing price drops, you start seeing the days on the market, you start seeing sellers, panicking, and you're talking to them, and you're like, yeah, I'm sorry, but you're going to have to drop your price. You're not going to get what you could a year and a half ago. These are facts. Now, we do have some markets, if the agent, this is a popular thing I hear, John. You're wrong, because the house down the street from me sold over list price in 2 days. What people don't realize is that in these scenarios, the chances are there was a very good listing agent behind the scene that said, we're going to drive this market. We're going to come in right priced the first time, and we're going to get activity, and we're going to then get over list price, and we'll probably get what you wanted and more originally, but we got to get the exuberance going. And so that's what we're still seeing, we're starting to see with good agents, is that they're pricing things right. If they overpriced the house like they did in 2020, 2021, beginning of 2022, you're not going to get what you thought you'd get, chances are.
Hey, Todd, it reminds me of 2008. How many times do you hear people say, I'm not going to give it away, and they wouldn't follow your advice on the price? I still think of this one client. They ended up, I was their first agent, and they didn't follow. They only need to lower it like 20,000 and they would have sold it. But there was that house on the corner, and now my house is a lot better than that one, and that one sold for. And this was common. So then they follow the market down, and like 3 agents later, they sold it for like 100,000 less than they could have sold it for when I had it. But hopefully that won't happen again. But people get economists call that, they anchor in on some price in their head on that house on the corner. And then at that point, you started to get one house would sell for really cheap. And there was like, that was a house. Did you see that house? Oh, that was under foreclosure. Just dismiss that. That was under foreclosure. So people would dismiss those really cheap houses, but eventually there got to be so many of them that it was started bringing down the prices. So I always like to say that I have done research on this. If you're going to get an above list price offer, it's going to happen in the first week or two. So you need to price it close to that. If you're more than a few percentage points above where it's going to sell, people are not going to make an offer. And then a month later, people think, how many times have you had buyers say, how long has it been on the market? That's like, why did they ask that? That's the second question they ask. How many? Oh, it's been on the market 2 months. Oh, let's come in low. So that's just kind of my way of pricing it. I tell people, like, price it to where you think prices will be in 2 months. If you think prices are going down, price it where you think prices will be in 2 months. If prices are going up, price it where you think prices will be in 2 months. And that's the way you get the most money out of it. But hopefully we won't get into that situation, which was so desperate, where people were chasing the market down. That was so sad, that they could have made so much more money if they just were more realistic.
You're 100% spot on, man. I mean, you couldn't be any more on point. How many times? I mean, and look, there's a saying in our business: your first offer is your best offer.
Yes.
You ever heard that before?
Yeah. Once or twice.
Well, why? Because they're the most exuberant buyer. I mean, the excitement for your property wears off the longer it's on the market. And I tell people, and look, as much as I am not happy with Zillow, they're the elephant in the room. We can't discount them or discard them. So when I'm putting a house on the market, or when my agents, or when I have an agent in another state and we're talking about the market conditions, when you are having a house hit the market and it's incoming soon or whatever, and if you put it on Zillow, if you're a premier agent, they allow you to put your coming soon on, and maybe they allow everybody now, I don't know. But if it's in coming soon status, a good telltale is how many saves do they have on that property? How many saves can you see on that property? I would always say that's going to tell me how my open house is going to be on Saturday when I launch. Because if I have a lot of saves on it, and I'm talking hundreds, 300, 400 saves, not 15 or 30 saves. And when you go to Zillow, you can see that, guys. You can pull up a house. You can see how many people have saved that property, meaning they want to watch it. They want to know when it hits the market. They don't want to miss it. But no question about it. I mean, the pricing is everything right now. But there's something I was thinking about I just want to bring up before we go on and talk about the '08 crisis, was that buyers also have to be smart. What we're talking about is sellers being smart by pricing it right in order to get the price that they're hoping that they would get by driving traffic the first week, the first 2 weeks, first couple days that their house hits the market. But you can't be a stupid buyer either. And what I mean by that, I'm not calling you stupid, but I'm saying a stupid buyer to know you got to, number one, have the right agent. So you got to make sure you have the right agent. That's number one, how to not be dumb buying a house. Have the right agent. But number two, that agent needs to tell you when something is priced low. Because I get a lot of times a situation where a good agent will come in and underprice that house by 10% or 15% at start. And then all of a sudden they get a bidding war going because it's priced really low. And the buyer's like, well, I'm not going to give them anything more than asking price. And you're like, you got to be able to identify when it's priced low too, because you may have to still give $20,000 over list price to get that house at a deal still, because the agent listed it so low. So you can't just go by the list price of the home, whether you think it's too high or you think it's too low. You need somebody that's smart in your corner that's saying, look, this one is really priced low to get activity. So if you don't want to get into a bidding war, don't go look at that property.
That was a really common strategy during the bust, what I call the slow motion auction, where they would intentionally go under market and they would get a lot of offers, because particularly if it was a foreclosure, then they could go to the bank and say, this was the highest offer we got, and we got 3 off, whatever. Because oftentimes they would get an offer and the bank would turn it down saying it's worth that much. But if you came in with a few offers, more than one, then they would pick the highest one. So that was very common, the slow motion auction, where they intentionally underprice it.
Yeah. Do you think that we could see something like 2008 or worse?
I didn't think we could see 2008. So I did not see that coming. I knew prices were high, but I never expected it to tank the way it did.
Neither did I.
My best case scenario is we get 10 to 20% adjustment, and then prices are flat for 5 years or more. So then eventually buyers are good. But that could be wishful thinking.
What I think about is, when I do these shows and I talk about what my thoughts are, they're very well thought out thoughts. They're not just something that I want to sell views on a video. I'm in the real estate business, for crying out loud. That would be terrible for my business to say something that I didn't feel was really happening. And I could be 100% wrong. I don't want to be right. That's the problem. I don't want to be right. I don't want to see us go through a downturn that harms a lot of people. I don't want to see that. I don't want to see people lose their jobs. I could certainly point a lot of fingers, and I think that our industry has some, of that, that culpability, not, I think the ignorance in our industry, because so many agents don't know or don't do enough transactions, or, they tell a buyer that they have to do something that they maybe don't have to do in order to get that. And I think that there's a lot of players in the industry that just their livelihood depends on it not, things not crashing. So I could see where lines get crossed, or just ignorance is bliss. And that, that's why I didn't see it happen in '08. I mean, I never got up every morning shaving, getting ready to go to work as a contractor, a builder, a rehabber, or investor, an agent, an employer, thinking to myself, tomorrow's going to be disastrous, right? And it happened over a period of years. It didn't happen overnight. But once it started to happen, it really happened. But what I want to talk about is subprime, because, and I've heard you even say this on a podcast, where you were saying that the market, and I'm just, just not blaming you for it. I'm just making a statement that you had said that the subprime market was, the reason, or a big reason, of the housing market crash. And we know today that that's just not true. And it's what they put out there. The subprime mortgage market maybe was the catalyst of the crash. But I want to just pull up a couple things here, because I don't want people to think that it's just me that's saying this, but there is data that shows it. And I do want to look at a couple things, because it is a material fact that the housing market crash wasn't just a subprime event. And then I want to talk about how, and I'm going to pull up some things on how the Fed stepped in and wrote about it, what they did to prevent it from happening again. But then we're doing the same things that we did back then. But let's just look at a couple things here. This is on the National Bureau of Economic Research. Again, all the links are below. And it's titled, "The U.S. foreclosure crisis was not just a subprime event." It's got a chart here that shows, contributions to the housing market bust. You could see the subprime mortgage, and then you could see the prime mortgage. You could see where the spike early on in 2008 was higher in subprime, but that quickly diminished, because subprime, I think, at the most accounted for maybe 20% of the mortgages during a very short period of time. They've always hovered somewhere around 15%, I believe, of the mortgages in existence are subprime. And I mean, there's a lot of question as to whether Fannie and Freddie are subprime lenders, themselves in the conventional market, or that FHA is in the, FHA market, the Federal Housing Authority. The crisis began in the subprime mortgage sector, but twice as many prime borrowers as subprime borrowers lost their homes over the full sample period. The many studies of the housing market collapse of the last decade and the associated sharp rise in defaults and foreclosures focus on the role of subprime mortgage sector. The author's key empirical finding is that negative equity conditions can explain virtually all of the difference in foreclosure and short sale outcomes of prime borrowers compared to all cash owners. Negative equity also accounts for approximately 2/3 of the variation in subprime borrower distress. So it was a big part, 2/3 of the subprime, but the bulk of them were in prime mortgages, not the cash owners. Both are true on average over time and across metropolitan areas. What I saw, John, working in sales, was a lot of the owners, when they looked across the street at their house, it was essentially selling for $100,000 less than what their mortgage was. They gave up. They threw in the keys. They're like, why am I going to pay for this? My gosh, I'm paying, my mortgage is $100,000 higher than what I could buy the house exactly, or maybe even nicer across the street. Do you know there's some housing markets that didn't come back from what they paid in 2006 until 2022? It took that long for a seller who bought in 2006 in a lot of markets in Maryland in the over $1 million range. If you paid over $1 million in 2006, you didn't get out of your house. A lot of them are still in the house, but if they had to sell, the prices didn't get to that 2006 range until 2022.
Yeah, here was about 2019. We got back to where they were at the peak in nominal terms. Now,
So what do you think about this? Because my concern is that since 2020, it could be quite possible that there are a lot of underwater homeowners.
One thing about that study, there's a trick people did in the language. There was subprime, but there was also in the industry they called Alt A loans. Alt A were what normal people would consider subprime, but the borrower was a prime borrower. So if you're a prime borrower and you get a
Bridge loan,
negative equity loan, or those crazy loans they had going at the time, those were the ones. In fact, you probably had to be a prime borrower to be able to qualify for a negative equity or those other, whatever the ones they were all going on.
They were letting people buy second houses and not paying off their other house, right? These bridge loans.
Yeah.
I mean, I know.
Oh, yeah, a line if it's going to be your primary residence. So what I saw here was a lot of the first people to pull out were the ones, they weren't necessarily subprime, but they were these Alt-A things. So particularly the ones where you had no money down, the no money down loans. And there was a study I got where it found out they were surprised at how many people defaulted 2 or 3 months after they bought the house. That's because they had no money down. The only money they put in was the monthly payment, and they see that prices are starting to fall. So why keep making payments? So
that's my point. But that was a lot of people. Well,
I'm saying that these were just these investors who were just doing short term, doing the Alt-A kind of stuff. They were the negative equity stuff. So that's
trying to flip the house, hoping to flip the house. And
yeah, so that was the goal. So that started the downward cycle. But when you get to be about, prices fell about, in Phoenix anyway, about 20%. Once you get to be about 20% negative equity, then people really started to bail out. Because if it's down 10% or whatever, a few people would walk away because they lost their job or whatever. But once you got to 20% or more, then that caused us a cascade. That was a big turning point right then, is when it got to be negative equity of 20%. And then it really fell from then on. So you got, so those people would have been prime borrowers who just walked away because the home fell so much. But I think it was started by the Alt-A buyers. And there was a lot of people, there was this word change. They didn't include Alt-A in the term subprime, although the general public would, but within the industry, they didn't.
It wiped out banks, wiped out financial institutions. I mean, it's a lot of, and I guess what I'm getting at here is that America is strapped. I mean, the middle class is strapped. I mean, it's, we're looking at people that can't afford their houses. We're looking at elderly that have to sell their home because they can't afford their taxes and their insurance. They are living in states where they didn't have insurance, and hurricanes, they lost everything. I mean, there's a lot wrong with this market. That's just to be, and to hear some of the commenters saying, well, you're wrong and home prices are only going to go up. I don't think that they're looking at all of the factors that go into it. This is on chicagofed.org. They have a chart here too. And again, I mean, how much of the Alt-A or whatever mortgages, would change this data to scale? I mean, if subprime only ever hit 20% of total mortgages, I wouldn't think that the, Alt-A financing would be a big number, a big percentage if we were to add it to it. I mean, I could be wrong, but I don't know that it would be. I want to talk about the repeating history, because a lot of people say that, well, history doesn't repeat itself, but it sure does look a lot like the prior downturns or booms and busts if you study them. The problem is we don't like to look back. We don't think that it's important. We don't need history. We don't have to worry about history. I've always said, if you want to plan your business, take a slight look back. Don't dwell in the rearview mirror, for crying out loud. But you still should understand what some of the problems of the mistakes were. This is on the Federal Reserve History.org. Steps to alleviate the crisis. Now, this was, we kind of, look, Bernanke, everything's fine. Greenspan's Fed put, protecting Wall Street, saying we can never let anything happen to it. Bernanke coming in, with the dropping these rates to zero. Powell doing the same thing in 2020. Here's the steps that they say will alleviate the next housing crisis. The government took several steps intended to lessen the damage. One set of actions was aimed at encouraging lenders to rework payments and other terms on troubled mortgages or to refinance underwater mortgages, loans exceeding the market value of homes, rather than aggressively seek foreclosure. Well, we saw that happen. Like you said, was that good for our market? Is that encouraging people at a level to buy a house and not worry about consequences of not paying the bill?
That tax credit did stop the fall of prices for a while, but then once it expired, they continued going down after that. I think I did a little deep dive in this. I'll send it to you on the real estate bubble, the great real estate bubble.
Says that Congress also passed temporary tax credits for home buyers that increased housing demand and eased the fall of house prices in 2009, 2010. Right. To buttress the funding of mortgages, the Congress greatly increased the maximum size of mortgages that FHA would insure. Because FHA loans allowed for low down payments, the agency's share of newly issued mortgages jumped from under 10% to over 40%.
They became like the lender of last resort because the non-government lenders weren't lending anymore. So fortunately, they were there to kind of pick up some of the slack because the private sector mortgage lenders were not lending.
Well, you know who's backing all these mortgages today, right? FHA is said to be the world's largest mortgage insurer, and Fannie Mae and Freddie Mac in the government's receivership, right? They took it over when it failed back in the crisis. Supports about 70% of the conventional mortgage loans in the U.S. Do you think there's housing market manipulation here?
Oh my gosh. Basically, the mortgage market is government controlled.
So, are they going to let it fail? Can they stop it?
They did have a thing last time where it paid for the servicer to foreclose quickly because the servicer, they didn't get paid when you quit making payments. They're not making any money. But then when the foreclosure was completed, then they got all their back payments, the first servicer, plus the foreclosure fee. So that incentivized them to foreclose fast in the states where it wasn't judicial. So that probably wouldn't happen this time. So it would be slower because it seems like they've been modifying mortgages. Like the guest that you had was talking about, you don't even ask and they modify your mortgage.
Look, over a million households had loan modifications in probably a year and a half time. I don't think what the mortgage moratorium ended in September 2021. So it was extended. So you didn't have to pay your mortgage until then. And they were they had all kinds of disastrous ideas. Well, we'll let you stop paying your mortgage for 4 months, and then at the end of 4 months, you make a lump sum payment of $30,000. People are like, if I don't have the money now to make my mortgage payment, how am I going to make a $30,000, a $20,000, a $15,000 lump payment in 3 months? So that was disastrous. And then all of a sudden, they came out with all these other things like, we'll take 30% of your mortgage balance and cast it into a second loan. And you don't have to pay it off until the last payment. And we'll make it a 40-year mortgage instead of a 30-year mortgage. We'll drop your payments. Here's the interesting thing. Again, these are steps to alleviate the crisis. The Federal Reserve, which lowered short-term interest rates to nearly 0% by early 2009, took additional steps to lower long-term interest rates and stimulate economic activity. This was Bernanke in 2012. What's the thing that caused, the number one thing that caused this housing crisis?
Oh my God.
In the last 4 years?
Totally the interest rates.
The interest rates.
By far the biggest factor.
How are they saying that these are steps to alleviate it? I mean, at what point do you say what you designed was maybe not a good idea, especially if it was somebody else that designed it? I mean, I don't know. If you're a CEO and you come into a company or you're an owner or whatever that you bought another company and you look at what they did in the past, you go, well, this didn't really, I don't know, maybe we shouldn't repeat these same things.
I got a crazy solution, Todd. Let's have that the Feds, they have their two mandates. One is stable prices. Let's add to a new mandate, stable house prices. Add that to the Fed mandate and see what happens. They're very happy to destabilize house prices to stabilize the rest of the economy and their other mandate.
And here's the conflict of that. And by the way, I love this. This conversation is great, John. You and I are going to be, I can tell we're going to be friends, and I hope to have you back on the show.
I'd love to.
I really enjoyed our conversation. I think you're brilliant. The thing is, we're in kind of this sort of boxed in scenario right now. Because, and I've heard it once, if I had a nickel for every time I've heard somebody say this, but the sellers, of course, want to sell their house for the most amount of money, but they don't want to give the next house owner, they don't want to pay them anything. And so what people have done even is they're like, yeah, I'm going to sell my house right now, which isn't, I would not say is a dumb move. I want to sell my house right now and I'm going to go rent somewhere. And then when the housing market, drops, when the home prices drop, I want to buy something where, I'm not going to give that seller that kind of money. So people are a little bit greedy, rightfully so. I mean, I get it, right? I'm not saying, but now you're in a situation because sellers don't want to see home prices drop, but they don't want to pay them either when they go to buy something else. So the only sellers that are benefiting are the ones that can sell at the top and not buy anything else.
It's a wash, whether it's the bottom or the top or the middle. If you're buying and selling at the same time, it's a wash.
But you may be getting a lot less house and paying a lot more for it. I mean, that's the golden handcuffs, right?
Yeah. Well, yeah, the interest rates are the thing that changes it more than the value. The saddest part of the whole bust was those people who retired. They had to sell at the bottom because they're got to go into nursing or something. That's the saddest part of the whole thing is they weren't around for the next boom.
What are you telling buyers and sellers? If you have somebody that wants to use you as an agent, what do you tell them? What advice for anyone listening, whether they're first-time buyers or first-time sellers and move-up buyers, or whether they're, going to consolidate and go into a multi-generational household, what do you tell people?
I'm always naturally cautious. I'm kind of an engineering personality. So I'm just like, as long as you know. So I would take them, okay, I like to show them a ton of homes so they know the market really well. And then so you're forewarned and you make the decision what's best for you. But I lay out that there's the downside risk. And sort of the best case scenario would be maybe flat prices, but I've been wrong in the past. And then they have to decide, because some people, you can't put it off. You just had your second child or you just whatever. Now's the time. You can't put your life on hold waiting for the market to somehow stabilize. What? Oh, it's something you probably aren't going to like, but I think one solution to this is to get more stable home prices. I think a lot of it is related to tax breaks that we give investors. There's so many tax breaks we give single home if it's the home you live in, but then there's all these other tax breaks that we give investors. It's like, why are we doing that? That's just you're
Oh,
just paying. It's
I'm
government
not
incentives to
investing in
pay
real
the
estate right now.
competition to drive
Yeah.
up prices and
Yeah.
lower the home ownership rate.
Yeah, I think investors belong in commercial real estate when you're buying at scale. I don't think that, apartment buildings or multifamily housing, I don't agree that we should allow investors to buy 50% of the available single family houses in the market. The problem is that, you know, asking the government to get in and put another regulation that it seems to be overstepped in every aspect of anything that they ever do is where do you put the stops and how do you do it so that it doesn't, we're a country of capitalism. I mean, that is, opportunity. And of course, with opportunity becomes income opportunity, growth opportunities. But I do think like HUD, they protect the home buyer in a government foreclosure for the first 30 days. They won't allow investors to bid on it. It's for home buyers or nonprofits. The problem, John, is that if you're the seller, what do you care? If an investor is going to come in and offer you a quick sale, offer you more money than a home buyer can, and then so you're not just fixing the problem is if you look at putting regulation in, you're not just hurting necessarily the investor, but you're really making the seller angry, saying you're going to tell me who can buy my house and who can't buy my house. The problem, and this is why I think a correction is the only way.
Okay.
Is because the market has been manipulated to the point that I don't see any fixes. I don't see any fixes. There is no fix other than realizing there's been big mistakes that have been made. We have to learn by our mistakes. If you're a company and you get overextended and you get yourself into trouble and your accounts receivable goes out of whack and they don't pay you, you can't pay your bills, and sometimes you have to do what? Start over. Sometimes that hurts, but there are mistakes that are being made. Are we going to bail out the whole country is the question. I mean, I don't know. That's why when I'm looking at all aspects of it, the only thing that makes sense is that we erase some of this gain that we've seen over the last 4 years and get ourselves back into an economy where people can afford stuff again. And that is going to take a process. It's happened before. We don't want to do it. We want to kick the can down the road, but sometimes we have to. And then what we need to do is put checks and balances in place that stops, these idiotic type of mandates and things that help the few and hurt the many.
Yeah. Or the stupidest laws talking about investor tax breaks is the depreciation deduction. A home can go up $100,000 in a year. They still get to depreciate it. That's it. And they wonder why there's so many investors coming in. And that's just one example of a zillion.
And you can accelerate the depreciation and actually, get a big tax break when you first buy the place.
Yeah, bonus depreciation. Holy
it.
mackerel! I think the bonus depreciation was a big part of the boom in 2022 because it was still you didn't have to pay any taxes for the first few years because of the bonus depreciation.
Why not give the same tax benefit to the homeowners?
Oh, there we go. Yeah.
Why not allow them to deduct the depreciation? Because a home's a depreciating asset. And people say, well, it's not true. It's the only No, it is true. The house will fall down around you if you don't do anything. You have to keep it up.
Or allow people to rent the house to themselves.
Yeah, I mean, there are definitely things that we could do to ease the tax burdens on Americans and help them afford to pay things like repairs. So, well, John, What a pleasure. Thank you so much, man, for joining us today. And I look forward to having you back. All of your information is in the show notes. My advice to you is my newfound friend is to start podcasting on your YouTube channel again, because I think a lot of people are going to like you from this video, and they're going to cruise over to your YouTube channel and they're going to subscribe, but they're going to want to see you give them some updates from time to time. And I think it would be, you do a good service to the community to do that.
Here's the answer to your first question, Todd. For about a year and a half, I was working on this big project called the 76 Secrets of Homeownership. And I quit doing videos when I did this. And now when I finished that huge project, now I can start doing videos again. So actually I bought a new camera and everything. I need to start doing that.
Well, hopefully we'll send a lot of people your way, and you'll be giving them great updates and content like you have.
Thanks for the encouragement
in the show. Yes, sir. And we'll be talking real soon.
Thank you.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.